Welcome to this explainer. Today, we're going on a seriously fascinating journey through the world of personal finance. Whether you're saving your very first dollar or figuring out how to deploy a large chunk of capital effectively, we're going to break down the exact strategies you need to build long-term wealth. I'm absolutely thrilled to guide you through this, so let's get right into it. Here's our roadmap for today. We're going to cover the magic of compounding, asset allocation, index funds and ETFs, building a dividend portfolio, and finally, lump sum versus dollar cost averaging. Building wealth, it's really not about getting lucky. It's about having a methodical, step-by-step game plan. Successful investing starts with figuring out exactly what you need, setting a solid target, and, this is key, knowing what kind of risks you're actually comfortable taking. Time is absolutely your biggest ally here. As we go through this explainer, you're going to see exactly how these core principles snap together like puzzle pieces to protect and grow your hard-earned money. All right, Section 1. The magic of compounding, your absolute greatest ally. So, what exactly is it? Well, in super simple terms, compound interest is basically interest on interest. Think of it like a snowball rolling down a hill. You aren't just making money on your initial cash, your principal, you're actually earning returns on the interest that has already piled up from the years before. So as more time passes, the growth of your wealth doesn't just tick up, it accelerates. It literally becomes exponential. To put this into perspective, let's look at Sally and Mike. Sally gets a head start at age 20, investing a pretty modest $100 a month. By the time she hits 65, she's put in $54,000 of her own cash, but thanks to an 11% average historical market return, she winds up with a whopping $1.2 million. Incredible, right? Now let's look at Mike. He waits until he's 50 to get started. He drops in 10 grand right out of the gate and aggressively shovels in $1,000 every single month. He invests almost 4 times as much of his own money as Sally did, $190,000 in total, yet he ends up with less than half of her final wealth. The takeaway here, starting early is just exponentially more powerful than trying to play catch-up with huge chunks of cash later in life. Now, if you want a super quick way to calculate this compounding magic for your own money, you've got to know the rule of 72. It's this brilliant little mental math trick. All you do is take the number 72 and divide it by your expected annual interest rate. The result? That's exactly how many years it's going to take to double your money. So say you're getting an 11% return, 72 divided by 11 means you're going to double your investment in roughly 6.5 years. Seriously, it's that easy. Moving on to Section 2, asset allocation and diversification. Get this, 91.5% of your portfolio's performance comes down to your asset allocation. Just let that sink in for a second. How you divide your money up among different categories is massively more important than trying to pick the next big individual stock. Finding that sweet spot between risk and reward, that is the real secret sauce to managing a successful portfolio. It helps to think of the 3 big asset classes like a perfectly balanced diet. First, you've got stocks, or equities. These are your growth engine. They give you the highest historical returns, but yeah, they do carry the most risk and the wildest price swings. Then you've got bonds. Think of bonds essentially as loans you make that pay you a steady stream of interest. They're a lot less risky and provide solid, reliable income. And finally, money market, or cash instruments. These are basically your safety net for preserving what you have, and they track short-term interest rates. The trick is balancing these 3 based on your personal timeline to smooth out the market's roller coaster ride. Which brings us to Section 3, index funds and ETFs, your tools for low-cost diversification. Okay, so both of these options track a market index, but they operate a little differently behind the scenes. ETFs, or exchange-traded funds, trade on the stock exchange exactly like individual company shares. That means you get real-time pricing and generally lower costs, but you do have to go in and execute the trades manually through your broker. Index funds, on the flip side, are bought directly from the fund manager at one set end-of-day price. Sure, they might have a slightly higher expense ratio, but, and this is a big but, they let you set up incredibly simple, automated set-it-and-forget-it investments. At the end of the day, honestly, both are fantastic ways to get low-cost, broad diversification. All right, Section 4, building a dividend portfolio to earn regular income. So, a dividend is basically your cut of a company's profits paid out directly to you in cold hard cash. And if you're looking for a top-tier quality-first approach, you really want to look at the dividend aristocrats. These are S&P 500 companies that haven't just paid a dividend, but have successfully raised their payout for at least 25 years in a row. Think about that. These businesses have survived the dot-com bust, the 2008 crash, global pandemics, and through all of that, they kept right on raising the cash they send out to their investors. That kind of financial resilience is incredibly hard to fake. Now, if you want to actually collect these payments, you've got to understand the mechanics of the timeline. First, the company announces it on the declaration date. Then comes the ex-dividend date, followed by the record date, and lastly, the payment date when the cash actually hits your account. But listen closely, the absolute most critical one here is the ex-dividend date. You literally must buy the stock before this cutoff date if you want to get the upcoming payout. If you buy on the ex-dividend date or anytime after, nope, the seller gets the cash, not you. So, once that cash does hit your account, what should you do with it? Well, you set up a DRIP, a dividend reinvestment plan. This is a total game changer. It automatically takes your cash payouts and uses them to buy more fractional shares of that exact same stock. And guess what? Those new shares then generate their own dividends, which then buy even more shares. It's the ultimate secret weapon for compounding tiny, regular cash payments into massive long-term wealth, all without you having to lift a single finger. Finally, let's jump into Section 5, lump sum versus dollar cost averaging, your execution strategy. I want you to really picture this for a second. Imagine someone wires you $100,000 right now. It's just sitting there in your checking account. What do? Do you log in, hit the buy button, and dump every last penny into the market this afternoon? Or do you play it safe, spreading it out, maybe 10 grand a month for the next 10 months? It's a massive dilemma, and honestly, it paralyzes even the most disciplined investors out there. Let's clearly define the two sides of this battle. On one hand, you have lump sum investing. This means you deploy all your capital at once in one single transaction. Boom, you are fully invested on day one. On the other hand, you have dollar cost averaging, or DCA. This is where you intentionally hold cash back and drip feed the capital into the market across regular purchases on a set schedule. It's an absolutely fascinating clash between cold, hard statistical math and human psychology. If we look strictly at the math, though, the data is actually pretty one-sided. Studies looking back over nearly a century show that lump sum investing beats dollar cost averaging roughly 67% of the time. That is 2/3 of the time over a 12-month period. Why? Simply put, because stock markets generally go up over time. Every single day you sit on a pile of cash, you are giving up the expected growth of the market. So, mathematically speaking, going all in immediately is the clear winner. But here's the thing. We aren't robots, right? If you put 100 grand into the market today and everything drops 25% tomorrow, the emotional gut punch could cause you to panic and sell at the absolute bottom. And that's exactly why dollar cost averaging exists. It's deliberately chosen by investors to prevent that exact feeling of regret. You're basically paying a tiny statistical premium in lost potential returns to buy yourself peace of mind and a much smoother, psychologically manageable ride. Now, if you're feeling totally torn between the two, don't worry, there is a highly practical, data-driven compromise, the hybrid approach. Step 1, you take 60 to 70% of your money and invest it immediately. This locks in that mathematical edge of lump sum investing. Step 2, you take the remaining 30 to 40% and slowly deploy it evenly over the next 3 to 6 months. It's kind of the best of both worlds. It beautifully balances capturing expected market growth while giving you that crucial psychological cushion just in case the market decides to take a sudden dip. Ultimately, when you look at all the data across all these different strategies, it points to one totally undeniable truth. Time in the market beats timing the market. Trying to sit on the sidelines, waiting for that perfect, elusive dip, it almost always results in missing the market's biggest days of recovery. Staying fully invested and just letting time do the heavy lifting matters so much more than obsessing over the absolute perfect entry point. So I want to leave you with this one final thought. Take a hard look at your current portfolio and your strategy. If your investments suddenly dropped 30% tomorrow morning, does your current plan give you the psychological confidence to hold on tight, or would you panic? Because at the end of the day, the absolute best investment playbook isn't just the one with the best math, it's the one you can actually stick to when things get scary. Figure out your risk tolerance, lock in your strategy, and let the magic of compounding go to work for you.